Okay, good morning. I'm self-filming today. It's still early. It's like early, right? My name is Leroy, head trader of 365 Trading Academy, and this is going to be the shortest video, kinda, that I've ever done. I'm going to quickly talk about dollar cost averaging, lump sum averaging, right? This is all related to stock trading, stock investing, right? And I'll tell you why I'm a big favor of dollar cost averaging, especially for the type of, financial climate that we're in right now, or the financial climate we're actually going into. Now, dollar cost averaging is quite simple, okay? But because this is my bias, I'm going to quickly explain lump sum investing first. Lump sum investing is you pretty much have a big stack of money, 10,000 rands, 20,000 rands, 1,000 rands, or whatever your lump sum amount is, and you just drop it on an asset, right? And you're hoping that over time, right, this is investing. So let's say over 5 years, over 10 years, over 15 years, over 20 years, you're hoping that your lump sum money has something like that. So it grows. So you put it here all at once, right? And you're hoping to gain that massive appreciation value of lump sum, money. This is good for bullish markets. So in the financial markets, in the stock markets, every 10 years or in 10-year periods, you'll get what's known as a bullish market. Just a strong upward momentum. You track the S&P 500, check the Dow Jones 30, you check the NASDAQ, all those tech companies. You'll notice that they are coming from, right? They are coming from a long-term bullish run, right? After the 2001 stock crash there, and yes, there was a couple of minor dips during the 2008 crisis, but 2009 crisis, the banking crisis, to 2019 or 2020, really where we were, is also another 10 years. So there's been a strong bullish market. So naturally, if you had a lump sum amount and you just parked it there, or you had a lump sum amount and you just parked it there, right? Over a while, you kind of get better returns, right? It's as simple as that. The reason why I am actually an advocate for dollar cost averaging, let's first define it. Now, dollar cost averaging means you put money, so let's say you got 10,000 rands, right? Just for an example. So you would put 1,000 rands every month on the same asset up until your 10,000 rand investment goal was done. All right, so every month. But here it is. Number one, it's systematic. Okay, you don't skip a month just because today, next month, the market is a little bit high. So you're scared, okay, now I'm starting to buy, let me wait for a dip or try and time the market. The whole point of dollar cost averaging is to avoid that, to avoid overthinking price, avoid overthinking markets. It's systematic. Every 4 weeks, you put in $1,000, you put in your $2,000, whatever it is that you've decided is your hallmark investment. Remember, I'm assuming you've done your research. I'm assuming you know what you want to invest in. You know why you want to invest in it. You've got some sort of triangulation approach, right? You've done your fundamentals. You've done your market analysis, right? For those of you who are subscribed to the 365 Stock Financial List, you know I do all that type of thinking for you, right? And then on a month-to-month basis, we keep adding to our portfolio. So this video is really for you guys. Dollar cost averaging. I want us to start applying that in a much more disciplined manner. Because every month, even if I present new opportunities, right, new trade calls, new long-term investment calls to take, I'm assuming that you're going back to the first financial note I sent you in March, the one that I sent you in June, July, August, and you are still dumping money into those assets, right? Because first of all, dollar cost averaging has a beautiful impact on what we call market timing effect. It reduces the stress of trying to catch these dips, right? If you're not, a trained financial market expert, if you don't understand how to read charts, if you're not really good at technical analysis, if you can't see that there's a difference between a retracement and a market reversal, with dollar cost averaging, you don't worry about that because your job is to be systematic. Every month, you just put money in those assets, right? Over time, and I'm going to get into a graph, right? As soon as I'm done with this particular paper whiteboard, I'm going to get into a graph in just a few seconds. I really want to keep this video short. But number two, dollar cost averaging dampens downside risk, right? If on the lump sum side, you invest here, but then something like COVID happens, where the stock markets dropped initially to about 20 to 30% low, Today is Wednesday, I'm making this video. On Monday, this same week, right, across the market, like the Dow Jones fell about 600 and something, 50 something points, okay, on Monday. We've got election swings, but we've also got COVID, like, re-emerging, right? So the markets are starting to price in all this stuff. It means your lump sum amount, if you invested a lump sum amount, gets hit, right, all at once. With dollar cost averaging, your risk is spread out. There's a dampening of your risk, right? So it helps. I hardly ever worry about my positioning and market size, right? Either way, if with dollar cost averaging, I bought here and markets went up and then they went down, and next month happens and I bought there, sorry if it's not clear, right? And then if price came back up and I bought there, and then price came back down and I bought there the next month, when price goes back up, this is a winner, this is a winner, this is now a winner, this is a winner, okay? But if there is a downside, right, the only position that might be affected are my last 2 or 3, right? So it dampens risk, okay? Now I want to quickly make this very practical. I've prepared a chart for you guys, you'll excuse me. I like these whiteboard effects. I do a lot of videos on web desk, on TradeView, etc. But I like the whiteboards. I like the 5 minutes chart on the whiteboards. Now, let's really take this in. I'm almost done, guys. I hope you don't mind if I use my police baton stick. Right, so there are 2 charts in front of us, right? This is the chart. This is every investor's dream, right? Sorry, I'm using a baton stick. This is every investor's dream, right? This particular chart here. At the top, this is the increment of price per share. So it's $20, $30, $40, $48, $60. So now I'm going to say I have 240. I speak in dollars a lot because this is generally my operational base, right? I'm a big fan of easy equities, the US dollar accounts, easy equities, the rand account, but I also invest a lot with IG markets, right? So we're just going to speak in dollars. You can just convert into your local currency. So now let's say I have $240 per month that I want to dump. I want to invest consistently in assets in the stock market, and I'm going to use a lump sum, or rather, I'm going to use my dollar cost averaging, right? I'm going to use dollar cost averaging. Chart 1 is a chart that we all assume, this is how the markets are going to be. So there we go. The first time I bought these assets, one stock was at about $20. I only have $240 to give per month, right? So I bought 12, right? I can only afford 12 of those stocks with $240. On month 2, price went up. So this appreciated to $30. So at $30 per stock, I could only buy 8. Then price kind of like stayed there. So the next month I got it again at $30. So I bought 8. Then price appreciated to $40, right? So check this out. Now I can only buy 6, right? Because as my stocks are gaining in value, they're slightly starting to become more and more expensive. But my budget of buying stocks on a month-to-month basis hasn't increased much. So I'm just taking what I can get. So when price gets to 40, I buy 6, price goes up to 48, now I'm buying 5, price eventually ends up at $60, right? So I used a simple mean average of 10 months of investing. After 10 months of investing, I would have bought 12 plus 8 plus 8, blah, 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 which works out to about 62 shares. So I would have bought about 62 shares, but the pricing of those 62 shares ends up at $60 per share. So at the end of the day, I would have made about $3,720 in a 10-month cycle of investing. Now, here's the thing about the markets. There are lots of dips, man. Fundamentals will trigger upside, downside movements. So you get the actual order blocks, the institutional order blocks, the true supplies and the true demands that actually move price, right? Following smart money. So most of your charts will look like this. Now, here's why dollar cost averaging is cool. So same budget, $240, right? Now, just ignore the first dot. We buy at $20, same. So I can only buy 12 shares, right? Then price goes up to $30, same. So I can only get 8 shares. Then price eventually gets to 40. When it's at 40, I can only buy 6. And then down, market drops, right? For whatever reason. So when market drops, it drops back again. This is now month 1, 2, 3, 4. I'm in month 4 and prices dropped to where I entered originally. So I'm back to $20. I don't close. I don't panic. trading psychology. I am a long-term investor. I know that I've done my homework, right? This is for someone who's done their homework. I know that markets now should experience a 10, 20, 30, even 35% decline overall, right? There's no ways markets cannot price in COVID, US election, global recession, technical recessions, the exotic, the emerging markets like South Africa, right? Basically a local massive suffrages, high unemployment. So there's no way the markets are not going to do some retracement, right? Some markets might even do a complete reversal. So the price goes down back to $20 from 40. But guess what I do? I buy 12 because at $20 per share with my $240 per month, I can buy 12. Then it gets worse. Markets drop. They drop lower and they're now down to $10. So fine. If a share is $10 with my $240 per month, I can now buy 12. I'm buying low. I'm buying this asset lower, right? It stays at $10, right? I want it here. I want growth psychologically, I guess sometimes that looks like this, but it's fine. I'm going to keep buying it low. So it's at $10, I buy 24. It stays at $10, I buy 24. It stays at $10 again, I buy 24. Eventually, right, 1, 2, 3, a whole financial quarter is done, right? Some earnings reports come out, things are getting better. Eventually, it starts to go up again, right? So now it goes back to the $20 where I first started off with. Well, we all know with $240 a month, the stock is back at $20. This is now month 1, 2, 3, 4, 5, 6, 7. This is now month 7. I'm back to buying 12 shares for the stock. And then it dwindles up a little bit. It stays at $20. I buy another 12. And then eventually I get a final push in month 10 where stock price gets to $30. Now I'm using 10-month periods. That's all I want you guys to focus on. At the end of 10 months, this chart is at $30. Which, by the way, is half the intrinsic value of this chart, where at the end of 10 months, price got to 60. But here's the thing about dollar cost averaging versus lump summing, right? And systematically being disciplined, right, to show up for yourself, right, for your future. I just kept buying. Even though it was low, I just kept buying. So you'll notice that in a 10-month period, because of the dips and the lows and me just always showing up with the same amount, systematically pouring in, I now have 142 shares, right? Yes, they are still at $30. Maybe next year I hold, right, and it goes up. But in this 10-month period, they're still at $30. But guess what? 142 shares at $30 works out to be $4,260 versus the $3,720 on this beautiful upscale movement, which not a lot of assets will give you, right? I quote here because I maintained dollar cost averaging, right? My name is Leroy. If you're still watching this video, I want to thank you so much. And we do this once in a while. If every book, if every library in the world burnt down, but you still wanted a core education on investing, on stocks, there is no better book than The Intelligent Investor. So, completely for free, if you want this book, right, I'll have to buy you, I'll use the Academy Fund, I'll buy you an e-version and send it to you just as a gift, just to say thank you for watching this video, thank you for sticking around for about 10 minutes, give or take, right? This is The Intelligent Investor. This is my third copy, right? The first copy in my home library should say, it's completely ratted up, I had to highlight, blah, blah, blah. But everything you'll ever need to know about markets, stocks, investing long-term is in here. If you're interested, all you have to do is just drop your email, just let me know you watched the video to the end, and I'll send this to you. Look, it'll take about depending on the emails we get, might still need about 2 to 3 days to buy everyone their ebooks, and we'll just send them as they come. As the emails come in the comments, we'll just send them. So just give us 3 days. No, please don't also be unrealistic. We have to buy it and then we send it, right? But it'll be an e-version for you. So if you're interested, thank you so much. Otherwise, thank you for your time. Check out my page, 365 Trading Academy. I'm going to walk around now to stop this video because I'm self-recording. It's only about 7 a.m. in my home. Cheers, guys. Have a good one. Dollar cost average. Do it. Do it. Do it. Hey, that's cool. That's cool. That's cool. Right. Cheers, guys.